Adobe stock fell after the company reported quarterly financial results on September 12th, 2024. The company is innovating rapidly and incorporating artificial intelligence across its suite of digital products. Investors are slightly disappointed with the company, given that expenses are growing at a faster rate than revenue. To make matters worse, revenue growth is decelerating, which is not an ideal combination for shareholders. Still, the company boasts competitive advantages in the high-end creative market, and in the investments in AI are making its products more useful to creatives. Now, I'll review the company's latest figures, compare them with the longer-term track record, weigh them against the valuation, and answer if I think Adobe stock is a buy on this dip here. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so total revenue in Adobe's third quarter of fiscal year 2024 increased by 11% to $5.41 billion, and earnings per share increased by 23% year over year to $4.65 per share. That's up from $3.76 per share. Operating cash flow also increased by 8% to $2 billion, up from $1.87 billion in the same quarter last year. Now, what we'll notice is that Adobe runs an asset-light business model, doesn't need to reinvest very much into the business, and that's attractive for long-term investors. All right, Adobe's business has long turned into a subscription business model where people pay for a monthly or annual subscription to Adobe's bundled services or individual services. And therefore, the remaining performance obligation number has become critically important because that signals how much remaining performance obligations will eventually turn into revenue. So it's a forecast of what revenue will look like going forward. So it was good news to see that Adobe's remaining performance obligations increased by 15% to $18.14 billion. This will eventually turn into revenue when the company performs these obligations. So if somebody signs up for an annual subscription, that will go into remaining performance obligations, and every month, a portion of those remaining performance obligations will turn into revenue as customers use the products they signed up for. If they pay up front for a product, or if they buy an annual product and use it monthly, Adobe cannot secure or cannot count that annual subscription as revenue when a customer purchases it. They can only count it as revenue when the customer consumes that product, usually on a monthly basis. I mentioned that investors were slightly disappointed in Adobe following the quarterly financial results. You can see the stock price declining here from closer to $600 per share down to $510 per share as of this recording on September 18th. You can see, though, that the stock price had been on a nice run higher after reaching a low of around $430 per share in June of 2024. It had bounced up to close to $600 per share. So it's been a volatile year for Adobe stock, falling to begin the first half of the year, getting a nice burst in the second part of the year before falling down further after these earnings results were announced. Now, looking back longer term, Adobe has done an excellent job in growing its revenue and profitability. You can see revenue jumping from less than $6 billion in 2015 on a trailing 12-month period, all the way up to $21 billion in the most recent trailing 12-month period. And what I like most about that is that it's lifted profitability much faster than it's lifted revenue. Operating income at $7.5 billion in the most recent trailing 12-month period consisted of a significant percentage of its revenue. So a large percentage of its revenue turns into profitability, and that goes to highlight that asset-light business model I mentioned earlier. Continuing on this trend, you can see Adobe's cash flow from operations in the most recent trailing 12 months and compare that with its capital expenditure. You can see that big gap there. They generated $6.7 billion in cash flow from operations, and they only invested $182 million in capital expenditure. So Adobe's investments, they're not in physical infrastructure, which are mostly attributed for in capital expenditures. Rather, Adobe's investments are more in research and development, which are expensed as occurred in most cases, employees, things of that nature. So it's not investing in these large capital projects, and that makes the business heavy and doesn't allow the business to grow as quickly as an otherwise comparable asset like business would. So this creates potential for the company to continue growing because it doesn't need to plow back all this capital every time it needs to experience growth. As of right now, Adobe's making investments in artificial intelligence, but these investments are not massive capital expenditures. Rather, they're investments in personnel, in talent, to try and develop these capabilities that will turn into recurring revenue streams for Adobe, which will pay dividends for a very long time. Adobe's return on invested capital has been steadily rising. This is one of the more important metrics I consider when evaluating a business. At 27%, it's significantly higher than where it was in 2015. And you can see further evidence of the company's economies and scale as it grows larger in revenue. Its profitability, its return on investments grows because the company doesn't need to put a lot of that revenue back into the business. It flows down to the bottom line more seamlessly than an otherwise more asset-heavy business model. Now, the analysts on Wall Street seem pessimistic on Adobe stock. They're only expecting the company to grow earnings per share at 12.5% each year over the next 5 years. That's about the rate where the company grew revenue in the latest year, in the latest quarter. Now, to expect the company's earnings per share not to rise much faster than revenue is putting a heavy influence on the investments in artificial intelligence. The analysts on Wall Street are essentially forecasting that Adobe will need to spend a great deal on its investment in artificial intelligence at the same rate that its revenue is increasing. Its revenue is increasing at roughly this same rate. So they're expecting that its earnings per share will grow at about the same rate as revenue. And that doesn't have the usual leverage in Adobe's business model. Typically, when Adobe's revenue grows by 10%, its earnings per share will grow by a significant larger rate than 10%. It has leverage in the business model given the economies and scale. So if I was to look at this earnings estimate from Wall Street and say if I think it's going to be over or under, I think it's going to be over. And you can see that in the past 5 years, Adobe increased its earnings per share at about 19% each year over the past 5 years. I would expect a closer earnings per share growth rate to the past 5 years. Not as large. I don't think it's going to approach 19% in the next 5 years, but I also don't think it's going to be as low as 12.5%. If I was making a forecast, I would forecast somewhere in between here. 15% seems like a reasonable midpoint to forecast for Adobe's EPS over the next 5 years. So given the recent sell-off, Adobe is trading at a forward price to earnings of 24.86, which I feel is a fair valuation for this company. I don't think this is a cheap valuation. I also don't think it's expensive. I think it's fair and slightly weighted towards being relatively inexpensive for a company with its prospects, with its profitability, its profit margin, its cash flow, and the asset-light business model, combined with the competitive advantages. So I've had Adobe stock rated as a buy essentially all year long. I last updated this stock on June 14th, recommending it as a buy. Now, following these results I've just evaluated, I will reiterate my buy recommendation for Adobe stock. I would say, yes, it is indeed a buy on this recent dip here. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.